commodity prices have rebounded spectacularly, and the miners generally are doing very well. Obviously, as I said, the gold miners doing particularly well, but all miners generally are doing better than expected.
Hello, welcome to Assay TV. Today I'm talking with Warren Gilman, who is the founder and CEO of Queen's Road Capital, based here in Hong Kong. We're both in Hong Kong at the moment, but unfortunately Warren has just flown back from Canada, so he is enjoying a few days of quarantine in his flat. Warren, great to see you. How are things going over there?
It's great to be back in Hong Kong, Leo, after 8 months of quarantining in beautiful British Columbia. I am dutifully wearing my home quarantine tracking bracelet so that the government can watch that I don't step out my front door. And it's going very well. I'm enjoying being back in Hong Kong. And it's actually been some very productive time. So I've got about 10 more days to go in quarantine. Frankly, I'm quite enjoying it.
Absolutely. And it's interesting times for the mining sector at the moment. I mean, it seems to be one of the sectors that's actually performing quite well through this period. And obviously, a bit of a headline grabber recently with Warren Buffett apparently sort of ditching the banks and buying into Barrick. What do you make of that? Is this a sign that generalists are starting to move into the mining market?
All sorts of points to be made there, Leo. First of all, it is an interesting time. To put a more exclamatory point on it, it's an astounding time. Who would have thought that the miners would have been a beneficiary of a collapse in global GDP? But here we are. Certainly, it's a fabulous time to be in the gold business. I don't make a great or put a great amount of importance in Buffett's investment into Barrick. At the end of the day, Buffett is effectively a fund manager these days. And like all good fund managers, he's just following the flows. And there's been a tremendous flow into gold, and Barrick is the largest and most liquid, and therefore he should be buying Barrick. I don't know if there's any relevance to the juxtaposition of selling banks and buying golds. I think that was more of a timing issue. But certainly it's great for headlines. It certainly is an underpinning of the point that fund managers, generalists included, are starting to buy gold miners where they haven't for the last 10 to 15 years, as we all know. So it's a great thing for the gold miners, and the momentum, from my perspective, on the gold side will continue. Obviously, the change in interest rate environment since February, March has been a game changer for the gold macro environment. And that momentum, I expect, is going to continue for some time.
And do you think that as we go into the sort of later into the year, as more company results come out showing the effects of the crisis, and at the same time you've got more mining companies bringing out positive results, do you think we'll see more investors take note of the sector when you've only got sort of tech and miners who seem to be doing well?
No question that's going to be the case, Leo, because commodity prices have rebounded spectacularly, and the miners generally are doing very well. Obviously, as I said, the gold miners doing particularly well, but all miners generally are doing better than expected. So they are going to get a second look. There's a bigger picture issue, though, that we have to deal with, and that is, as you know, the mining industry, the most successful players in the mining industry trade generally in the range of 4 to 6 times EBITDA, whereas the marginally successful or even companies that are at very, very early stages of development on the tech side can trade at 50 to 100 times EBITDA. So the upside for generalist fund managers is still extremely skewed towards tech and other industries that trade for better upside at much, much bigger multiples. And at the end of the day, we'll get a second look because we're doing well. But the bigger picture is we have to change that mindset and get generalists to believe that miners who own resources in the ground are worth many, many, many more multiples than they're willing to pay them.
Sure. And do you have any take? Do you have a take on where the gold price and where that's going to go from here?
Yeah, as I said, I think the change in interest rate environment is a game changer for the gold price. Interest rates won't be rising anytime soon, whereas a year ago I felt quite strongly that interest rates were on an inexorable rising trend for the next several years as we finally dug ourselves out of this low interest rate environment. Given the deficit funding that the planet has entered into due to the pandemic, that has changed entirely. So the macro environment for gold has changed entirely, and my view on gold has done a 180-degree turn given this change of events. And I'm quite bullish on the price of gold in the near to medium term. It reminds me very much of the 1980s, and I remember as a young fellow waking up every morning in 1980, and the gold price was on this tremendous move, 400 to 450 to 500 to 550, and then it started gapping up in $100 increments. We went from 500 to 600 in a day, 700 to 800. And we're in that type of environment again right now. Now that we've attained the $2,000 mark, I would not be at all surprised to wake up in the morning one morning and find that gold was up $100 to 2,100, and then up another $100 to 2,200. We're in uncharted territory here, so very little in the way of caps on where the price could go in the near term.
Although it's had a bit of a pullback in recent weeks, is that to be expected given the enormous run up prior to that?
Yeah, I think that's fair, Leo. I think it's just a consolidation, building a foundation around the 2,000 level before we move higher. I think that's probably a fair assessment.
And looking beyond gold, are there other commodities that you're particularly interested in at the moment?
Well, as an investor, my style is more of a long-term investor and not a trader. So environments like this are great for your existing gold positions, and maybe you want to sell into rallies. But making new investments is something that I would tend to have a bias towards things that are out of favor at the moment. You might have seen that my company, Queen's Road, has made its first two investments, both of which are in the uranium sector, where I think prices are still quite depressed when one takes a long-term view of prices and the supply-demand dynamics of that market. So it's areas like that that are still out of favor and not as hot, if you will, as the current market. That's where we're looking for opportunities at the moment.
And the uranium market, uranium price has recovered somewhat of late. What do you see as the key drivers in that sector?
It has recovered certainly quite a bit. We finally, after many years, have benefited from producer discipline, which certainly has not been evident since Fukushima. So the fact that we have closed down MacArthur and closed down Cigar and finally got a very tangible move towards a price over volume strategy by Kazatomprom, that has changed the market considerably. So the whole issue with respect to uranium is supply. Demand is robust. Demand is growing. There are more nuclear reactors on the planet today ever in history. So when you look into the demand side of the equation, it is strong and growing and will be for decades to come. The great thing about the nuclear business is there's a great deal of long-term visibility on the demand side. So that's not a problem. The only issue stopping uranium prices from going higher are the major producers themselves. They have the power to make uranium prices a lot higher, and we are starting to see that discipline kick in amongst the main uranium players. And as long as those players remain disciplined, there's no question that prices will go higher, because there is no new mine development today other than the one that we are invested in, which is NextGen, which is economic at today's levels. So in order for any new mines other than NextGen to come back on stream, uranium prices have to be significantly higher, not just 10 or 20%, significantly higher for those new mines to be economic and provide a reasonable return. So that, in my mind, is inevitable. That is coming. That will happen.
In terms of making any new investments at the moment, what are some of the challenges that the current situation, puts up?
Leo, that's a great question, and it's one that I'm dealing with on a daily basis. I have the benefit of being around in the industry for many decades. There aren't many mines, indeed, there aren't many properties around the world in almost any commodity that I haven't put my boots on over the course of that period of time. So to a certain extent, I've done a lot of pre-due diligence already. I'm already familiar with these projects. So there are a lot of projects that when we come to make an investment in, I don't need to actually put physical boots on the ground, even though that is our policy and that we need to put boots on the ground. If I've already done it previously, I don't necessarily have to go back. And the last two projects that Queen's Road has invested in have been a beneficiary of that, in that we've been able to make those investments without effectively having to do any more physical due diligence. Because I've been up to the Athabasca Basin and been on those properties many times already. But there's no question that as this period drags on, new projects come up, new opportunities develop. There'll be opportunities that we'll want to invest in where I have not had my boots on the ground and where I will want to do that. And that's a bit of a challenge. And we're dealing with that specifically on a deal that I'm currently working on. And we're trying to come to terms with how we can address that. Can we actually get boots on the ground? How long would that take? And if it's just too long a commitment of time, what can we do to mitigate our due diligence risk? And of course, that means even more thorough desktop due diligence. But it's a very relevant point. It not only affects my investment business, but obviously is going to affect the global M&A market. And make deals, completing deals, more and more difficult in the next year or so.
I mean, is that going to lead to more investors looking at projects in jurisdictions where there is sort of existing expertise on the ground that you can contract to go and do the due diligence for you? So that would favour projects in maybe British Columbia, Western Australia. Anywhere in Canada, but maybe prejudice projects that are in more remote locations.
Yeah, absolutely, Leo. That's absolutely correct. It makes things that are near to home a lot easier to invest in, and therefore, the investment horizon will be skewed, and the M&A horizon will be skewed to those projects that are nearby and a little bit more familiar. It depends to a certain degree on your investment style. I have never hired a consultant. At the end of the day, the investment decisions are mine, and therefore it's my boots that need to be on the ground. I can't rely on the report of a consultant who I may or may not know, but in any event, it's his opinion, it's not my opinion. If you're a bigger company that has a consistent track record of relying on consultants, you'll probably continue to do so. But I think you're right. You're going to stay reasonably close to home and try to reduce your risk as much you can in that regard by staying close to home.
Absolutely. Well, thank you very much for sharing your thoughts there on the market today. It's very interesting times we're in. I hope you enjoy the rest of your quarantine, and look forward to catching up with you when you're out and about a little later.
Thanks, Leo. Good to be back in Hong Kong, and good luck with the conference.
Thank you very much.